Hello and welcome to our Midlands Off the Road webinar. We've been out and about talking on the road sessions across the UK over the past few weeks. We're delighted to have many advisors and power planners come and join us for coffee and listen to what we had to say. We understand there's lots of you that are unable to join us, and we need online content which is in demand. So we're putting on this catch-up session to ensure everybody gets to hear our sessions. A copy of the recording will also be available at the end of the week on our Investcentre portal. So if you would like to recap or pass on to a colleague, please feel free to do so. The session does qualify for structured CPD and will supply your certificate based on your time in the session via email in the coming days. And I'll also send you a copy of the slides. For now, however, I'll kick off the session with a business update on what's been going on here at AJ Bell Investcentre. So my name is Billy Singh. I'm the regional BDM in the Midlands, and I'll be providing this quick update on what's been happening at Investcentre. So firstly, just to recap in terms of issues within the platform space. Obviously, you're all aware of the disruption going on with lots of platforms having issues, private equity getting involved, lots of takeovers and mergers. And one of the key issues is the underlying profitability of platforms or lack of profitability. So this report that came out last year from Finalytic just kind of highlighted the scale of platforms in terms of assets versus their profitability. And it's quite interesting reading, so I'll just spend a quick minute on it just to kind of put you in the picture and make you aware of what's happening. So you can see there the top 5 or 6 platforms, you know, the big names, Aegon, Fidelity, Aberdeen, Quilter, ourselves and Transact. So we kind of dominate the marketplace. If we look at the corresponding profitability, the top 2 players, Aegon and Fidelity, they're in loss-making situations. So, and that's often because due to their low-priced kind of fixed pricing deals, that's really kind of just buying the business, but it's essentially unprofitable business and it's adding to their losses. Aberdeen and Quilter, obviously traditionally quite a bit more expensive, so they have good margin and are on the sort of top 6 or 7 platforms making money. And then you have ourselves, again, roughly about joint third alongside Quilter and Aberdeen in terms of assets, but crucially, you know, very healthy profit margin, third from the top, and that's with a sustainable pricing model that's low cost and been like that for quite a few years. So definitely a sustainable proposition that's got the scale but remains low cost. So the reason I'm obviously highlighting this is that, you know, it's important for yourselves to kind of align yourself with platforms that have got a sustainable proposition, that are on the sort of top third of the profitability table and are likely to be around in the next few years. So moving on from there, just to talk a bit about the scale and size of AJ Bell. So here's just a few numbers in terms of the assets that we manage, the number of clients, you know, nearly 500,000, member of the London Stock Exchange, and probably north of 1,000, probably closer to 1,200 employees. So definitely a large business that's got scale, but is a trusted member of the platform community. Looking at kind of recent financial updates that we gave to the marketplace, this just shows our long-term growth opportunity. So on the top left, you can kind of see that we're growing at probably twice the rate of the overall platform market and nearly 4 times the rate of the broader wealth sector. So definitely a strong growth trajectory. And again, that's depicted on the bottom right-hand side in terms of market share, both in our advice channels and also the direct-to-consumer channel. So definitely a longer-term sustainable opportunity that we're capitalizing on. And just kind of looking at the most recent results, it's been a very difficult year over the last 12-18 months. Obviously, everybody experienced significant volatility. There's been huge outflows on many platforms. We're proud that we've kind of stayed in positive territory in terms of adding to our assets under administration, adding to the number of clients, and again, boosting our revenue. So definitely a safe pair of hands, strong balance sheet moving forward. So just a refresher on what's available through us in terms of products and services. So multi-generational platform with all the key wrappers, right from the junior products right up to 2 pension products, the full SIP or the retirement investment account. And then you've got other things like flexible ISAs, charitable trusts, designated accounts, offshore bonds. So plenty to choose from and aggregate to kind of provide a diversified solution to your clients. Moving on to the kind of investment choices. So our funds and share service is a broad offering, well over 4,000 different kind of instruments, and we're not crucially just mutual funds. So you can buy all sorts of things like ETFs, investment trusts, direct shares, gilts, corporate bonds. So a full array of products that can be held within the different wrappers. Moving on in terms of other managed portfolio solutions, so MPS solutions, again, adding to this list all the time, quite a diverse list there. Most recent additions have been the IBOS MPS, and we're just onboarding Evelyn portfolio. So again, plenty to kind of diversify and outsource with. And then moving on from there, you have your full DFMs or investment partners, as we call them, over 17 of the big names there. Again, if that's what you like to use. And then we also have an off-panel route. So this is where you can hold things like trustee investment plans with the likes of Peru, external stockbroker accounts, external deposit accounts. So plenty of things to choose from in that arena. There's definitely been a much more higher demand for cash options and a cash equivalent. So a number of things here that advisors use. Firstly, our platform interest that we're paying has gone up recently, so a healthy 3.15%. Many advisors are using things like direct gilts, where you can get yields of over 5%. Money market funds, the likes of BlackRock Sterling Liquidity Fund, or managed solutions, so Tatton release to cash MPS. You've still got the NSI products, fixed term notice accounts, and tips. So quite a few things in terms of the cash arena as demand increases for that. So going on to the crucial part about value and price and cost, and we feel that we're remaining close to our mantra of staying low cost. So in terms of the pension offerings, the retirement investment account targeted at below 200 grand pensions is all-in cost of 0.25. No other ancillary costs. So definitely a great competitive lower-end offering, pension offering. Then if you're looking above 200 grand, then we'd recommend our full SIP, which is 0.2 up to the first million, and then it tiers lower according to investment level and caps out around 2 million. There's just for the clients that are going to draw down, there's £180 plus VAT per annum charge on that. And the reason we have this £200,000 threshold is below £200,000 if you use the SIP, you'd get charged administration quarterly fees. So to circumvent them, we recommend the RIA. And then finally, the other products, ISA, GIA, LISA, JISA, it's that same charging structure starting from 0.2 and then tiering lower. One other thing to note is that we aggregate the wrappers to reach the different thresholds. So again, a great way to kind of drop into a lower tier. So moving on to one of the crucial aspects, and one of the things that many platforms are faltering on, is the support and service that you can expect from us. So great statistics here up to the year up to the 30th of June. So we handled just over 400,000 calls from our advisor servicing team, and over 93% were answered within 6 rings. So quite a proud statistic there, and something that's monitored on a regular basis to ensure that we stay within those kind of SLAs. And in terms of emails, over 96% answer within 24 hours. So definitely a service that you can rely on. And then just looking at my localized team. So in the Midlands, you got myself looking after the region. And then you have my colleagues Sam Hill and Josh Gray, who are desk-based BDM supports. And they're there to kind of really onboard sort of businesses. So as you need the training, you need to get familiar with the platform and registration, your first few cases to kind of get into the swing of things. Those guys are there to help hold your hand throughout that process and to make sure that you're fully supported. Then you have Andy Adshad. He focuses more on the investment side. So again, if we need to do more of a deep dive into our multi-asset solutions or MPSs, then Andy's the man, and he can accompany me on any meetings to kind of provide that additional support. And then we're all under Alison Mollard, who's head of sales and takes care of all the regions. So just to finally finish off, I just wanted to touch upon our investment offering, again, which is grown a lot of legs, a lot of traction. So just to give you a quick update, over a 5-year history now, we're probably approaching near 5 billion in terms of under administration. We've won numerous awards. One of the most awards that stand out to us is the Citywire Choice Awards this year for the most satisfactory investment outcome for clients. And we really like that award, like I said, because it is providing that ultimate enhanced outcome for our clients, which is the most important people. And so, yeah, very proud of what we're achieving on that space. And again, enhancing the sort of platforms that you can buy the funds on, and also the MPS solutions on. So that's increasing all the time. And just kind of a quick summary of what's available. So we've got a set of multi-asset funds, which are actively managed but implemented using passive building blocks. And then we have a range of managed portfolio solutions that are available in various iterations. So you've got your passive, your blended, your active, and your responsible, and income range as well. And they're designed to be simple, transparent, low cost, easy to document and explain to your clients, and all the information and quarterly updates are available on the platform, so that you can kind of communicate any changes within these investments directly to your clients. And also they are modeled quite tightly so that they perform in line with the modeling. So definitely something to kind of be aware of and to do your own due diligence around. And in terms of investment team, a wealth of experience, headed up by Kevin Duran. We have Ryan Hughes, who's I think employee number 2 at AJ Bell nearly 30 years ago. Jamie Ward and Samantha, and lots of analysts below them. So probably 15, 16 members of the team, and increasing all the time. So lots of headcount there to kind of really produce results. And finally, just kind of looking at the risk mapping. So they're risk mapped to most of the risk profilers out there. We can send you this so that it can fit in with your processes. And just finally, in terms of costs, very competitive. So the funds are priced at 31 basis points, and the NPS solutions start at 28 basis points. So really, you can kind of envisage an all-in cost of fund plus platform for around about 50 basis points for quartile 1 performance, which is pretty impressive. So please, pull me aside or ask for more information. I'd be more than happy to kind of share stuff for you to do your due diligence around. So that's it for me. Thanks for your time, and I will conclude right there. Right, here to set the scene today on our investment markets, dusting off his crystal ball to look at what we can expect in the coming months. Up next is Russ Mould, Investment Director of AJ Bell.
Hello, I'm Russ Mould, AJ Bell's Investment Director. Greetings from the studio in our London office. And I'm going to talk today about the Magnificent Seven charts on what they might mean for you and clients' portfolios in 2023, and more importantly, beyond. So yes, I'm a big fan of the Magnificent Seven Western, the original one, looking at the screen here rather than the newer version, which was okay, but not quite so good. And obviously we start with Yul Brynner and Steve McQueen there. And then as a pub quiz question, if you can email me and let me know who the other 5 were, then well done to you. But Brynner and McQueen are the dead easy ones. So We're going to very quickly look at what's been happening in the markets this year, because that's what I'm really good at, telling you what's been and gone, because I can read that out of the newspaper. The tricky bit, well, that will come with the Magnificent Seven in the charts to try and help us see what might be coming down the pipe. So in terms of 2022, well, natural gas and oil were the winners. Commodities overall did okay. Gold didn't lose you anything or your clients anything, but bonds and equities found it tough going, and Bitcoin was tail end Charlie. Now, the whole thing's flipped around. Bitcoin's had a pretty good year, though it's been losing a little bit of altitude of late. Global equities have been back in fashion, fired by the US in particular. Gold's hung in there. Oil's now putting on a bit of a wiggle. Natural gas, last year's biggest performer, has been very weak indeed, as Western Europe in particular has found a good job of finding liquefied natural gas and even reducing its energy consumption in other ways, whereas bonds still found it fairly tricky going, as the inflation narrative remains lurking in the background. Now, by equity markets, again, we've probably seen a fairly similar reversal of fortune from 2022 to 2023. So last year, emerging markets were doing well. Brazil and India were the kings or queens of the hill, and the FTSE 100 actually didn't do too badly. The big laggard was NASDAQ, as technology stocks fell out of favor, burdened by lofty valuations, lofty expectations, and rising interest rates. Hong Kong and China also found it difficult as lockdowns persisted. This year, NASDAQ has just gone like Bitcoin, has gone from last to first, helped by hopes perhaps for a pause or a pivot in interest rate expectations, lower valuations, lower expectations, which firms like Meta and Apple have generally exceeded this year. Japan's kept on buzzing along quite happily because it's the only country in the world still virtually with negative interest rates and still plowing ahead with quantitative easing. China and Hong Kong have found it difficult to keep going even after the end of lockdown, and the poor old beleaguered UK has lost a little bit of momentum. So why is this? Why have we seen this reversal of fortune, or what's the big picture drivers for that? Well, firstly, valuations just did get cheaper. Had we been doing this a year ago, and I think we actually did one a year ago, then recession was very much the key theme, and the debate wasn't whether there would be one, but whether we'd get a hard landing or a soft landing. Frankly, now equities are busily trying to persuade themselves there's actually going to be no landing at all, at least in the United States. That's been helped by the fact that gas prices have collapsed and oil has stopped going up, although it's now actually at its highest level in November. That's seen as taking a little bit of pressure off inflation, and in turn taking pressure off these lovely people here, the central bankers who are calling the shots. And again, there is no doubt that the pace of interest rate rises has begun to slow after fairly prompt rates of increase. So as you can see here on this chart, 367 global rate hikes in 2022. The tally for this year so far is nudging towards 150, but we're well into the year, and there have been more rate cuts. Now, in terms of the cutters for this year, it's probably not a company you necessarily wish to keep. The economically unorthodox, such as Turkey, or the economically troubled, such as China and chunks of Africa. But there are one or two more encouraging stories there, such as Brazil and Chile. They were early movers to raise in their fight against inflation, so you could argue they called it better than the Federal Reserve, the Bank of England, and the European Central Bank. And they're now reaping the rewards because they're already starting to cut. So there may be something there for emerging market followers to bite onto in 2024 and beyond, if indeed inflation is under control there and you are starting to see an easing in policy, because they are markets that are still relatively out of favour, as we've seen already. And also, even though we are seeing rates going up, perhaps a deceleration there, central bankers are still trying to tighten policy in another format through quantitative tightening. This is the aggregate balance sheets of the European Central Bank, Bank of England, Bank of Japan, US Federal Reserve, and European Central Bank. And as you can see, the balance sheets are now shrinking, down by about 10% year on year. Bank of Japan is still adding, but the others are trying to make a fist of it and actually withdraw some of the stimulus. The Federal Reserve has now actually withdrawn around a quarter of the stimulus that it pumped in during the pandemic. But overall, their balance sheets are still swollen. The chances of them getting back to where they were in 2020, maybe back to where they were in 2008, absolutely no chance. So although they are still running quantitative tightening, you would still argue, looking at balance sheets in aggregate, there is still lots of monetary stimulus out there and policy is still pretty loose. Something to bear in mind when we go back to talking about that inflation narrative. For all the central banks talking stuff tough, they're still running it fast and loose in other areas. So equities, I think, as we've just discussed, have probably convinced themselves we may get no landing, continued gentle growth, even a return to the Goldilocks economy of steady growth, contained inflation, low interest rates, an environment that did so much to help assets perform across the board, whether it was equities, bonds, or some of the real trash like Bitcoin and non-fungible tokens. I'm just not convinced by that narrative, and that isn't advice. It's just my particular opinion, in that we've just had 15 years, as we've seen on the previous chart, of highly unorthodox monetary policy in the form of quantitative easing, and policy is still loose based on that. Yes, interest rates have gone up, but they're not historically high, particularly relative to inflation. And it just feels a bit pat that after big monetary stimulus, big fiscal stimulus during the pandemic, that we all just go back to where we were and everything's all jolly and nice and straightforward again. It just feels a bit too pat. Anyway, equities think that may be the case, and so far that they're being proven right. But there are three other possible scenarios, and it's pretty easy to make a call for all of them, an argument for all of them, which from your perspective and the client's perspective is tricky, because if history is any guide, then all three require a different portfolio answer in terms of strategic asset allocation. History is no guarantee for the future, we must accept that, but it's certainly something that's worth bearing in mind. So what's the case for inflation? Well, as we just discussed, monetary policy is still loose in many ways, and you're still getting fiscal stimulus coming through, particularly in the United States of America, from the CHIPS Act and the Inflation Reduction Act. Bidenomics, in short. The trend towards onshoring or friendshoring, to use a nasty neologism, well, that means that we're employing more Western workers and fewer cheaper emerging market ones. That just means the goods are going to be more expensive. And energy, we've noticed again that oil is back at its high since November. Uranium is back above $62 a pound. That's up 30% year on year. Energy security may mean that energy gets more expensive, and also because again domestic sourcing. And also we are telling oil companies not to knock holes in the Earth's crust, and they're listening. Their capital expenditure is quite low. Banks aren't financing their projects. Insurers aren't insuring them. So the drillers aren't drilling them. But energy demand continues to go up, and it will always do so if there's economic growth out there. And if demand is going up and supply isn't, well, 101 economics tells us that that means that energy prices are going up. What's the case for deflation? Well, this is an interesting one. The demise of trade unions has been held up as a reason for, or their emasculation has been held up as a reason for modest wage growth for many years. However, now that employment is low, we can see lots of cases of unions flexing muscles, not just in the UK, but also in the US, where the UAW is now joining the Hollywood writers on strike and demanding some pretty meaty pay rises. So the deflation case could even be moving into the inflation one. But overall, unions do not have the power they had in the 1970s. Overall membership is down, and that is a case for deflation, if not at least disinflation. Demographics, potentially deflationary as people save more through greater longevity. And tech and productivity, well, they're designed to be price crushers. Moore's law in the silicon chip industry, we get the same price, but double the technology, or double the speed and productivity and power in 18 to 24 months' time. That's inherently disinflationary, if not deflationary. And the argument for stagflation, well, debt is still the elephant in the room. It is still going up, and that zombie firms are still hogging capital. Cheap money may have been wasted, misallocated during the boom times of the last 10 years when money was ultra cheap. And a lot of firms that have added a lot of customers, but have never turned them into profit, so they've almost created a profitless prosperity situation. Well, yes, they've been very disruptive, but they've not actually made any money. So they are definitely weighing on prices. It may therefore, if rising interest rates knock some of these firms out of business, that rising interest rates could perversely be inflationary by reducing supply at a time when we're being swamped with the stuff. We shall see. But precedents for all of these, well, inflation, we've seen that in the UK and the US in the early 70s, emerging markets in the 2010s. If history is any guide, you want it to be in real assets, stuff that central banks can't print, which are generally commodities or buildings or land. You probably want to be in fairly short duration assets if nominal GDP growth is good. That's cyclicals, deep value commodities. And maybe if you're really in the mood, index linkers, though I know they are a very acquired taste, and they're a taste that our Chief Investment Officer, Kevin Duran, hasn't got. Now, in terms of deflation, well, this is the direct opposite. Thankfully, cases are rare. The US and the UK since in the 30s, and Japan maybe you could argue since the 90s. Then you want it to be in long duration assets because interest rates stay low. You want to be in growth assets because there's not much growth around, and bonds and cash and tech and biotech do very well, thank you very much, in that environment, if history is any guide. Stagflation is trickier. Not many examples, just the benighted UK in the late 1970s. Gold did well, and then you needed pricing power stocks, which generally meant anything could stick down your throat or down the sink, or defense companies. Although the 70s was not necessarily a time marked by war other than the Middle East, it was marked by a time of the Red Brigade, the Baader-Meinhof gang and other things, and there was a bit of a mini war on terror going on. So a wide range of outcomes there, all needing perhaps different portfolio solutions. So the question is, how do we spot what's coming around the corner? Because let's face it, central banks don't know. They're the people who said that inflation would be transitory 2 years ago, and they've been proven to be spectacularly wrong. Governor of the Bank of England, Andrew Bailey's even said publicly that the Bank of England's inflation models are based on the last 30 years of data when there's been no inflation. And the Office for National Statistics has just revised its productivity and post-lockdown GDP growth numbers. Garbage in means garbage out. So when central banks say that they're being data dependent, then there's clearly a risk of error there if the data is no good. And also the data is backward looking when they're trying to set policy for 18 to 24 months down the road, because that's how long it takes interest rates to have an effect. So if they're driving the car looking in the rear view mirror, there's a pretty good chance they're going to crash into something eventually. So how do we spot what's coming down the corner? This is where the Magnificent Seven come in, those Magnificent Seven charts. So which charts tell us that indeed we may be going back to the Goldilocks or the disinflationary world? Well, this one does for certain, because it's telling us that tech is back in fashion after its year in the gold in 2022. So this is the aggregate market cap of Amazon, Alphabet, Apple, Meta, Microsoft, Nvidia, and Tesla, or more personally, the year-on-year change in their market cap relative to the year-on-year change in the S&P 500 index. As you can see, frankly, at one stage in the spring this year, those 7 firms had added all of the S&P 500's gain and more, which doesn't say much for the other 493. The good news is there is now more breadth to the American market. Bad breadth is a bad sign. It means too many people are relying on too few stocks. And if anything goes wrong with any of them, then watch out. So a good positive sign going forwards will be better breadth from the US equity market and less reliance on this septet. Though a return to low growth, low rates, low inflation would favour them because they were seen as secular long-term growth players almost regardless of the economic backdrop. Back to where we were. I love not just old westerns, but planes, trains, automobiles, ships and trucks, because if they're doing well, the economy is generally doing well. This is Dow theory, where the transports go, the industrials follow, and generally what we're seeing here is that the argument being is that if the transports are doing, the economy is doing well, the transports will do, because if goods are being sold, then they have to be shipped and inventory and shelves have to be replenished. But if the economy isn't doing well, goods aren't being sold, aren't being shipped, and shelves do not have to be refilled. So the good news here is the transports has had a really good run this year. That plays to the maybe we're not going to get a recession at all angle, which is what the equity market's looking for. But as you can see here, the transports haven't yet got back to their late 2021 peak, so the picture might be a bit more nuanced than we think. And then another great economics proxy, silicon chips. Now, you may have heard a lot about the ARM Holdings initial public offering in the United States. ARM is a particularly interesting company, looking particularly interestingly valued right now. The good news is the semiconductor index, the SOX, that's Philadelphia Semiconductor Index of 30 global stocks traded in America, has had a thumping run this year, up about 40%. Again, maybe struggling to get back to its all-time highs, maybe losing a little bit of momentum, and this is important for 2 reasons. The silicon chip industry is a $600 billion a year sales global business. It's plugged into pretty much everything from your smartphones to your laptops, from servers to smart meters to industrial robots to medical equipment to cars, you name it. If the world economy is doing well, chips are selling. If it's not doing well, they might not. So keep an eye on this. And the second reason why this might be interesting is chip stocks are momentum jockey stocks. They feed off upgrades, they're recoiled from downgrades. So they're a great guide to global risk appetite amongst investors. A good run for the SOX. Surprise, surprise, the NASDAQ and the S&P 500 have done well this year when the opposite applied in 2022. So for the equity market to be right, you want it to keep on pulling its SOX up. What you don't want to see is the SOX falling down and chip demand starting to weaken, that could play to the soft or hard landing thesis, which is not what equity markets are looking for, but perversely it is what bond markets are looking for. Equity markets are still all believing that there's going to be perhaps no recession at all now, or even a very gentle one, helped particularly in the US by Bidenomics and that fiscal stimulus. Bond markets don't want to know. As we all know, if you lend somebody money for 10 years, you will look to charge them a higher interest rate than if you lend them money for 2 years, because more things can go wrong in between. However, looking right now at both the UK and the US, the 10-year Treasury and 10-year gilt yield is below the 2-year Treasury and the 2-year gilt yield. This is known as an inverted yield curve. It's traditionally seen as a warning of a recession because it's the fixed income market's way of pricing in future interest rate cuts in response to economic weakness. This is a pretty accurate guide normally to recession. The odd false alarm along the way, but not many. But at the moment, it's been inverted for a good year. Equity markets haven't listened, and frankly, economies haven't listened. Even the UK has managed to dodge a recession thus far. The US certainly has. You've got talk of 6% GDP growth annualized right now in the US in the third quarter of this year, according to the Atlanta Fed. But if the bond market's right, there's recession coming. We shall see. Also, another favorite indicator, small caps. They are much more plugged into their domestic economies. They don't have the breadth of management, breadth of product or service to really go too far from their domestic market, and that's why they're seen as a proxy for local growth. The Russell 2000 in the US is putting a bit of a spurt on. FTSE All Cap in the UK is dead as a door knocker, and these indices have done nothing since late 2021, which again doesn't really fit in with the no hard or no soft landing thesis. Now, US small caps again could be benefiting from trickle down from Bidenomics, maybe, but also the reasons that multinationals might be doing so well in the US beside Bidenomics is their treasury departments. They refinanced very aggressively into 2020, 2021, locked in low rates. So that is deferring any pain from higher interest rates from the Federal Reserve until they refi 5, 6, 8, 10 years down the road. They'll also be getting positive carry because they're getting 5.5% now on their cash. Small caps probably aren't as cashed up, aren't as savvy, don't have the treasury facilities. So that may be one reason why small caps are lagging large caps. We shall see. But I don't like saying it's different this time because you're normally wrong. Bond market inverted yield curve, small cap weakness normally means economic trouble ahead, whatever the equity market's telling me. This is perhaps still the elephant in the room. This points to certainly stagflation, possibly deflation. You know, debt is a killer. And look at the interest burden on the US federal government debt, the red line here, absolutely going through the roof. It's now running at $1 trillion a year annualized. America's tax take is what? $5 trillion? $3 trillion goes on welfare, $1 trillion goes on inflation, $800 billion goes on defense. That leaves $200 billion for education and everything else, which really isn't enough. So America is going to be heavily overspending again. And intriguingly for coincidence watchers, the federal deficit this year will be about 6% of GDP, bang in line with that Atlanta Fed GDP growth forecast right now. So it does feel as if a lot of American growth is coming from Bidenomics and fiscal stimmy. I'm not saying that's going to wear off in 2024, given there's a presidential election coming, but I'm not convinced it's entirely sustainable either. And if you look at underlying US tax take, it's down year on year. The private sector isn't really enjoying itself right now. This is another inflationary or stagflationary warning, perhaps. Very tricky. If oil really gets a wiggle on, that could put the hammer down. We've seen headline inflation rates come down, but the core CPI numbers really haven't. And it's the core one that excludes oil, food, drink, and things that are obviously really important, but economists don't care about because they're volatile. But if oil gets sticky, then that could drive overall headline inflation up central banks in a terrible bind, because that previous chart really means that they don't want to push interest rates up for too long. The UK's average interest bill now is about 110 billion pounds a year. If it was a government department, only the NHS would be costing more. That doesn't feel very sustainable or very comfortable either. So central banks probably would quite like to get rates down. And I'm suspecting that in the case of the Fed, that its big gamble is with all of that corporate debt refinancing in 25, 26, their big gamble is they can get inflation down and rates down before that wall really starts to hit corporations hard. But oil going bubbly won't help that calculation at all. So where are we? Equities think we're going back to Goldilocks, low rates, low growth, low inflation, no soft landing, no hard landing, happy days. Bonds and small caps are not convinced. They're on recession alert. Commodities at the moment are looking at energy being stronger for longer, and that's a big complication, may even point to stagflation if the deflation eases or the inflation eases, is that right? But it's definitely a big complication. One final chart for you. This is the Bloomberg Commodity Index against the S&P 500 index. If the line is going down, equities are outperforming. If the line is going up, commodities are outperforming. We've just had 10 years of massive equity outperformance. So that's why, again, I'm just intuitively uncomfortable with thinking of, well, we're going to go back to what's worked, because the history shows that isn't necessarily true. In addition, capitalism rewards scarcity. There's not been a lot of commodity exploration capex for the last 5 or 10 years. None at all in the case of uranium after Fukushima in 2011. If there is decent nominal growth and there is further demand for raw materials, there's not a lot of supply growing. That's the kind of thing that capitalism rewards. Whereas in equities, we've had money thrown every which way but loose, courtesy of ultra cheap money. So if commodities start outperforming sustainably, and they had a go at it last year and then petered out, that might just tell us the mood music's changing and that we're not going to have 10 years of low growth, low rate mush. We might be getting that bit of inflation with commodities a key part of that. So let's keep an eye on this chart above all of the others. That might be then the Magnificent Eight. Of course, the original Magnificent Seven were Yul Brynner, Steve McQueen, Horst Buchholz, Brad Dexter. They're the really hard two. Robert Wagner, Charles Bronson, and James Coburn. Thank you very much for your time. I greatly appreciate it, and hopefully see you on the road in the flesh very soon. Thank you.
Thank you, Russ. Any questions you may have, please put them in the chat box or complete the feedback, and that will automatically load at the end of this webinar. Next up is our Head of Policy Development, Rachel Vai, with a session, Understanding the Changing Needs of Clients and Shifting Consumer Behaviour. Rachel will spend the next 20 minutes diving into the FCA's annual Financial Lives survey and provide analysis to a shift in UK consumer behaviour. This is huge, valuable insight for advisors on the changing needs of clients, so to be sure to get your notepads ready for fascinating stats.
Hello, my name is Rachel Vai and I'm Head of Policy Development here at AJ Bell. I want to talk with you today about the FCA's Financial Lives survey. Now, this came out a couple of months ago, and it's a really big piece of research that really delves into people's financial lives. The FCA is looking for critical things that are happening and to try and find out how people are coping financially. This is a flagship piece of research from the FCA. It is a massive piece of research as well, and one that they are very, very proud of. It comes in 3 parts. So first of all, there was the Financial Lives survey, and this is the main bulk of the research results. And this was carried out over a year ago in May 2022. The FCA surveyed over 19,000 people. So you can imagine this is a really big, in-depth piece of research with lots of valuable data. On top of this piece of research, the FCA also did a cost of living survey, and they carried this out in January 2023. And that looked over the previous 6 months to figure out how people are coping with the cost of living crisis. And on top of that, they did some qualitative interviews. And these were carried out in January and February of this year. Now, this all put together, this is a tomb of information and data. This is the 3rd edition that the FCA has done. The first was done in 2017, the next one was done in 2020. So not only is the FCA looking at a whole raft of information, it's also comparing it back against previous years to find out whether there are trends developing or what's changing. There are 3 ways the FCA uses this piece of information. The first is to find out areas of concern or where they think that serious consumer harm is happening. And if that's the case and they find out areas where they think they should be taking action, then they put that within the 3-year strategy. So it's to find out things that they need to take action on. The second way they use it is to look at monitoring FCA policy. So policy changes that they've put into place, for example, consumer duty, they want to see whether that's bedded in, to see whether it has changed things and made financial lives and people's financial lives better. So they want looking at it to monitor their own policy. Third, it fits into different reviews that the FCA is currently undertaking. For example, at the moment, the FCA is looking at retirement income advice. And information coming from this piece of research will no doubt be fed into that sort of review. The FCA is very, very proud of this piece of this research, and they would love it if we all appreciated it as well. They want advisors to read it, to understand it, and to hopefully get a better sense of their financial lives of their customers and their clients. This is a snippet taken from the foreword to the paper. I'm not going to read this verbatim for you, but it goes to show how much the FCA relies on this piece of research and how they are keen that we all read it and to understand the research. And it is an interesting piece of research, so I do urge you to go and have a look. Okay, so let's start looking at the results. I'm going to start by looking at the cost of living additional research, which was carried out in January and February this year. Now, the cost of living crisis is hitting hard for many people in the UK, and there's lots of people who are financially struggling. I do appreciate that advisors, clients have more financial resilience than the general population, and they have the support of their financial advisor to help them through this. But the cost of living crisis is a wide thing. It's a change of society's mindset. We are all very much aware that some people are struggling very, very hard, and it does change the decisions that we all make. There are so many pieces of statistics and data I could have picked out of this research to show you. So I've only just limited it to just a few. 77% of people said they were finding it difficult to keep up with bills and credit commitments, that times was tough. And 11% said, actually, it's worse than that, I'm in financial difficulty. And that's up from 8% when the FCA last asked that question. So I think that's really indicative of how many people are struggling in the UK. Another statistic is that 71% said they had no disposable income. So they had no money left over at the end of the month to save or invest or to put aside for the inevitable rainy day. And I found it quite stark that half the people they surveyed said they had stopped, or they had reduced their savings, or they had dipped into their savings or investments. And I think if you have a low financial resilience anyway, that just shows that times are going to be very tough for people, and then just not able to save anything else. The Treasury and the FCA are always keen to find out how people are coping within the current cost of living crisis and what that means for their savings and for their pensions. 6% have stopped or reduced their pension contributions, and the survey found out as well that 6% had fully encashed their pension or taken out a lump sum to help ends meet. Now, if you really want a good indication of what's happening with savings and with pensions, then looking at the automatic enrolment opt-out rate is probably a really good place to start. In August last year, in 2022, this was 10.4%. Now, this was a really big increase up from the previous data, which was January 2020, which was 7.6. So 7.6 up to 10.4 is quite a big step. I think it would be really interesting to know what the current opt-out rate is and whether this is creeping up more and more. The silver lining with all of this is that retirees are they're coping okay. Financially, they're all right. And that's because a lot of them are receiving or in receipt of a fixed income or an income that is linked to inflation. For example, many retirees are still receiving a defined benefit pension. And so that is going to be linked, or maybe linked to inflation or a steady increase. And of course, if they're receiving the state pension, then because of the triple lock, they are enjoying very good increases to that state pension. Now that was 10.2% increase last April, and we've just got news that the increase next April is likely to be 8.5%. So 10.2% one year, 8.5% another year, which is very, very sizable increases. Now, whether that means that we need to have a review of exactly how the triple lock operates and whether it is appropriate, I think that is probably due now. And I think both political parties are maybe going to signal that they're ready to have that discussion. So let's move away from the cost of living crisis and look at the main body of the research. The FCA was keen to look at consumer duty. And what it's doing here is it's setting a benchmark. It will carry out another financial life survey next year in May 2024 to publish the year after. So what they're looking here is to compare results against last year's and next year's and to figure out where things are changing. Now, they're looking across all financial services firms. So it's not just platform companies or pension companies or savings. It is across the whole range of financial services firms and customers. They looked at customer support. Only half the people said that they had actually claimed some customer support and got in contact with some customer support. But where they did, 84% said, yeah, it helped, it was good, it worked for me. The FCA also looked at whether the products were meeting the customer needs. A lot of this is going to be focused on value for money and whether charges are too high or whether it did what it said on the tin. But it's also to do with shopping around. The FCA is always keen to understand whether people are shopping around for their financial products. Now, I thought it was quite interesting that within the research, the FCA looked at whether people were shopping around for how easy it was to shop around. And in one bit, they compared pet insurance. Shopping around for pet insurance came out as 90% of people found it easy to do that. But they also said that only 68% of people found it easy to shop around for income drawdown. Now, I find that quite a juxtaposition to put forward. I'm not entirely sure it's the same process to shop around for those two different financial services products. The FCA also wants to look at communications. 27% of people didn't find communications helped at all when making a decision. But on the other hand, 20% said yes, it did help. So I think there's just a range of responses there. What is interesting is that for vulnerable customers, that figure of 27% increased to 40%. So vulnerable customers or customers with vulnerable characteristics are struggling a little bit more with communications and support and getting the right sort of product. And that is very apparent all the way through the FCA's research and looking and what they have said about their research. As you've put consumer duty implementation into place, I'm sure that you've looked at your vulnerable customers and how they are coping and to make sure that there are solutions available for them. And I think this is one angle that the FCA is going to pick up on as part of its implementation review. Okay, so turning now to trust in the industry and the provider. Well, the trust in providers and the industry is not spectacular. Only 4 in 10 people said they've got confidence in the UK financial services industry. And I thought it was quite damning that only 1 in 3 thought financial firms were honest and transparent. When the FCA dug a little bit deeper in the qualitative interviews to find out why people's trust and confidence was low, then people cited things like the banking crisis of 2008 and bailing out banks and bankers' bonuses and PPI mis-selling and things like that. And I think that what this goes to show is that these set pieces live long in people's memory, and that's really the general perception of the industry, and it's going to take a long time to row back from that. However, when the FCA asked people about their trust and their confidence in their own provider, specifically their own provider, they were generally happy. Now, I've included some data here for looking at some different financial services products, some annuity, mortgage, income drawdown, cash ISA, and a DC pension. But as you can see, these figures are generally really high. People had either high or moderate satisfaction. So they maybe had a problem with the industry, but not with their own provider. How did they view their advisor then? Well, I think these are really positive figures. You can see from the bottom three graphs the level of trust and satisfaction that people have in their financial advisor. So all these this data is taken from people who work with a financial advisor or have received financial advice over the last 12 months. And generally the levels are really high. So where they do get financial advice, it's working out well. People trust them, trust their financial advisor, they've got high levels of satisfaction, and they've got confidence in the advice plan that they have been set. Looking at that 19,000 people that they surveyed, only 8% had received regulated financial advice in the previous 12 months. And the number that were receiving it from a financial advisor firm had remained steady over the last few years. Where there had been a slight increase is the number of people who were receiving online advice, and that had increased 8-fold. Now that sounds spectacular, doesn't it? But it is only 800% increase on a small number is still a small number. So it's still only about 1% of those surveyed. But it does show that it is increasing slightly in some areas. The FCA went on to ask why people like advisors and why they trust their own advisor. Now, if you're looking to build your client bank and you're looking to review your communications and how you position yourself as a firm, then this slide might be of interest. It shows that people really appreciate the FCA regulation and the safety net that gives, that they're looking for a brand or reputation that's really quite high, and that professional qualifications are crucial. And I think that all stems towards building a really good, solid profession. Recommendations are also key, whether it comes from a friend or a family or an accountant or solicitor. So maybe including testimonials within websites and the way that you position your firm is really useful. I also wouldn't be too quick to dismiss things like Google reviews. It could be that people really rely on these to figure out how other people like them have experienced the firm and have experience of a firm. So I think these things are really important. So people who are using regulated financial advice, who are getting regulated financial advice, are generally very happy with it. And I think that's, as I said, I think that's really positive. But the FCA was also keen to find out how people who don't receive it, but should receive it, view financial advisors. Now, the FCA looked at their survey and they reckon 28% of the people surveyed should be getting regulated advice. Now, this is their definition, but their definition was anyone who had more than £10,000 in investable assets or had more than £10,000 in a DC pension and was within about 2 years of making a decision about what to do with that money. Now, what they found with these people, they asked them about if they thought financial advisors were unbiased, whether they trust financial advisors to act in the best interests, and whether they think they are professionals. And you can see from the top 2 columns, those are people who agree with those statements or slightly agree, strongly agree or slightly agree. And I think it's a bit of mixed views, really. I think that the fact that they do view, and over half the people view financial advisors as a profession, and it's a strong profession, is really positive. But there is probably some work to do in other areas to knock down barriers. So one of the areas the FCA is very keen on is to make sure that more people receive support and guidance when making decisions. They have set up an advice guidance boundary review. And this is looking at this magical line just between what is given, when a communication is guidance and when a communication is advice. And the concern about some providers and employers about not overstepping the mark and not, for anything they say, straying into advice. So the FCA is going to give us a lot more information about where that boundary lies to hopefully help people, to help providers and employers give communications that can help people and support people in making decisions, but is not regulated financial advice. But they also need to look, I think, wider than that, and to look at closing the help gap within the UK to make sure that more people receive support and guidance. Now, part and parcel of that response and that solution has to be increasing the access to regulated financial advice. But there might not be many people out there who want to work with financial advisors or can't find a financial advisor to work with. And there is a question whether advisors have the capacity or the desire for new clients as well. The FCA is also keen to make sure that the people who do need support and guidance get it. So one of the areas they're looking at is how do they support and how does the industry support people making decisions. Together with the Treasury, the FCA has set up a review of the advice guidance boundary. Now they're looking partly at the line between what a communication is, whether it is advice or whether it is guidance, to make sure it's very clear which side of the boundary and which side of the line it would fall into. And this is to give comfort to both providers working directly with customers and also employers to make sure that they know what they can say to customers or their employees when they're making decisions, and to be confident that they're not straying into regulated advice. But this review has turned into a much bigger piece of work, and is now looking at how to reduce the help gap to make sure that people get support from when they are making these big decisions. There are several things that the FCA and the Treasury are pondering. Now, one of these is simplified advice. You might remember that last year the FCA issued a consultation on simplified core investment advice, looking at how to give simplified advice around a stocks and shares ISA, where you look at a reduced fact find and just focus on giving advice at that one particular point, just on transaction, not on ongoing advice, and whether that would work in practice. We did some research with advisors and asked if these FCA proposals would fit into their business model, or it's something that they would like to expand to include within their business model. And 93% of advisors we talked to said, no, this just simply does not work for us. Now, I'm quite relieved that the FCA has decided to drop these proposals for the meantime, and they've decided not to go ahead with that particular bit of the consultation. However, they have rolled the proposals into this broader advice guidance boundary review, and to see whether simplified advice could play a part. If it does, then it has to fit into advisors' business models, and it has to work on that basis. There are other things that the FCA and Treasury are looking at. One of them is regulated guidance, whether that's regulating the people who are giving a certain level of guidance or what that guidance says. But it's looking at exactly how to give more personal information, but again, not straying into regulated advice, but giving them more information and more support than currently get. Part and parcel of this has to be including and widening out access to financial advice as well, and regulated advice. And I think that's an important part of the proposals that the FCA and Treasury should be looking at. Finally, the review is also considering pathways. So looking at the progression of someone's decision making, and whether they can say whether they chose decision A, then decision B, then decision C, will give an output at the end of what you could say to someone. And I think that is needs a little bit more work and consideration. It cannot be too restrictive or too contained, because people's lives don't work like that. It's much more nuanced. So I'm not entirely sure whether pathways could work in practice, but we need to see what the FCA and Treasury are proposing. And hopefully we will get a consultation or a discussion paper on this in the next few months, certainly before the end of the year. Turning now to look at specific savings and investments. Let's start with pension saving. The FCA wanted to know how many people were saving within a pension, and the answer was, of all the people who were not yet retired, 67% of them were building up a pension. The people who weren't were people who were unemployed, or they didn't earn very much money, or they had opted out of automatic enrolment, or the self-employed as well. And I still think there's quite a bit of action that the DWP and probably Treasury and government in general need to take to encourage some factions of the self-employed to save more for their later lives. The FCA also asked people who were saving, how much are you saving? You can see from the graph that it's banded into different pot sizes, and that the majority of them haven't really built up a very big pension pot yet. And I think that's understandable. Automatic enrolment is still in its relatively early days, and obviously as time goes on, these figures will increase, especially as now we know that the lower earnings age is going to be reduced from 22 to age 18, and that it's going to contributions are going to count from the first pound of earnings upwards. So these are both positive things that have happened, and these now just need to be implemented within the automatic enrolment rules. There are a couple of stats here which I found quite alarming. First of all, just under 1 in 10 people didn't know whether they were building up a pension or not. Now, I'm a strong believer in automatic enrolment and in the power of apathy, but I find that a little bit alarming. I think if you are in a pension scheme, even if you didn't choose to be there in the first place, you should know about it. The second one is people who don't know how much they have got saved. Now that was 30%, so 3 in 10 people just couldn't put a figure on how much they had saved within a DC pension pot. I realise that there is an element of cynicism about Pensions Dashboard, but I think it could be a very strong motivator to increase engagement between people and their pension savings. Now, if we can encourage them to go onto the Pensions Dashboard and to pull the data towards them, then they can find this out and maybe find out they've got more pension pots than they knew about and more pension savings. How do people take their pension pots? Well, again, the FCA wanted to understand that, and I think these graphs probably reflect what you know is happening already. A lot of it is partial encashment. People are maybe dipping in and out of their pension pots to take a little bit of cash or a little bit of income drawdown at times when it really suits them to do so. 1/4 of those who had access to their pension pot was still working. Now, I found that a little bit on the low side, but it may be with that financial advisor clients that this figure is a little bit higher. These are the sort of statistics that are going to feed into the FCA's review on retirement income advice. Turning now to look at investments. The FCA asked people, do you invest and where do you invest? So the answer was 41% of people said, yeah, we have investments. And it covers the broad range of everything that you would probably expect, really, and where you think that people would probably invest their money. What I found was quite interesting was a little slot which the FCA included, a little bit which they drew out and have focused on younger people. Now, those people who are aged between 25 and 34, there had been an 11% increase in the number of that age category investing. So that's really quite a big jump. And there was more men who had increased their saving than women. I think this relates to the increase in high-risk investments and the fact that that had doubled to 8%. And when the FCA looked at investment in crypto assets, they found that had gone up threefold. So quite considerably more people are investing in these type of investments. The FCA dug a little bit deeper and asked people, why are you investing in these products? Why are you investing in these type of investments and crypto assets? And they gave them a range of reasons why. And 85% of the people chose quite an emotional reason. For example, they said it was challenging, or it was novelty, or it was fun, or it was a gamble. which I thought was very worrying. But I think what this shows is that we've got a new cohort coming forward of risk-hungry, emotional, maybe men, who want to look at these particular assets and want to invest in these particular things. And I think the FCA this will cause a few sleepless nights for the FCA to figure out how they can support these people in taking this investment. I want to end on a positive note by looking at pension investment scams. Now, the pensions cold calling ban came in quite a few years ago, and there is now proof that it is beginning to work. In 2017, 22% of people received an unsolicited approach, but that had fallen to only 9% this time round. So I think that's really positive that fewer people are receiving these approaches. However, out of those who did, 8% responded to the approach and 3% lost money. Now, one pension scam it's one scam too many. So the FCA needs to really keep on top of this. The FCA and the government need to keep aware of how pensions and investment scammers are working. Because if one thing is guaranteed, once you think you know how it's all working, and once you think you know what the model is, that's the time when the scammers change it. So in summary, the Financial Lives Survey is a key bit of research from the FCA. It is very big and very comprehensive. There is a lot of data there, and I do urge you to go and have a look, because I do think you will find some elements of it really interesting and pertinent to your clients' financial lives. The FCA is looking at it to monitor consumer duty, and it's obviously looking for results to be positive next time round, to show a key difference and to show that the dial has moved. Generally, people don't trust financial services, but they do trust their provider. I think there are some issues still remaining around how many people are accumulating pensions and how many people just don't know how much they've got in their DC pension pot. And obviously, investment in crypto assets is the key concern for the FCA, and I would expect them to continue to look at this area in depth. If there is one positive message I would like to end this with, is that the people who do receive regulated financial advice do see its worth and do have trust and confidence and satisfaction in their financial advisors and their financial advice plan. And I think that's a lovely positive note to end on. So thank you very much for your time. If you do have any questions, then please feel free to get in touch. Thanks. Bye.
Thank you, Rachel. Again, any questions for Rachel? If you'd like to know more about her analysis, please note this on the feedback form at the end of the session or in the chat function. It's time for a short break. We'll be back in 5 minutes, just enough time for you to top up your coffee, and we'll see you back here shortly. Welcome back. Next up with a few minutes update on our AJ Bell investment range and performances, investment business development manager Andy Agshed.
Hi, my name's Andy Agshed. I'm the investment development manager for the North, which incorporates the Midlands, the North and East and Northwest of England, Scotland and Northern Ireland. I'm going to give you an AJ Bell investment update as part of this webinar. So let's crack on. Little update in regard to where we're up to in terms of AUM. So we've gone through the 4 billion mark now. And I would attribute a lot of the growth to, well, a couple of things really. Time. So, you know, you guys in IFA land obviously want us to have a track record. Now that that track record is over 5 years, that's been a significant tick box for a number of IFA firms. So they've been able to assess not only performance, but the consistency of return profiles. So we can see that on slide, 72% up year-on-year growth. Driven significantly as well by the low-cost nature of the investment solutions, and I'll come on to that a little bit later. And you can see at the bottom there that we did win an award from Citywire. You know, I often joke about this. It wasn't for the brochure or the quality of the presentation of the material. It was something that was significant to clients, so the most satisfactory investment outcome. In other words, clients sort of beginning to feel as though they're invested in a place where the consistency is there, and also some downside awareness, some management of risk, which is why people like yourselves outsource. So what do we do? So what does a core investment strategy look like? Quite a busy slide, so I'll try and make this as simple as possible. If we start from the top down, so risk targeted. So the growth proposition is risk targeted. That's part of our governance framework. It's designed to ensure that if you recommend a solution that's a mid-risk profile, so somebody who is a balanced investor, sort of circa 50% equity as an example, then you've got this sleep at night characteristic, that risk profile 5 out of 10 per se isn't going to drift into a 6 or isn't going to drift into a 4. So that isn't a situation where we're buying in asset allocation or we're told which assets to buy and which asset allocation in that asset allocation process. It's simply a measure by volatility. So in this example, we use distribution technologies volatility bands. We set our own asset allocation inside, and then we manage the expectations to those volatility bands to make sure that we're keeping our risk classification. So that's pretty much the top. These are gold standard risk targeted portfolios. So again, that helps you as part of your process and the understanding of the client that it's going to meet their risk profile expectation. You look down the side, it says 5 different implementations. So if we start sort of top down, so there's a passive MPS proposition. Use the word passive loosely, populated by ETFs. It isn't passive with a rules-based approach, so think of that as a low-cost proposition. And then if we move down sort of vertically, top to bottom, so passive, what we call Pactive, which is a blend of the investment funds, a CEDO-coded range, and the active MPS proposition. So that's a blend of active and passive, 50-50 split. There are tolerances around how far that can deviate. So obviously, if the active solution outperformed the passive solution, then you'd see that 50-50 split move. There are tolerances around that in order to maintain its 50-50 process as accurately as possible. And we move on to the active MPS, responsible MPS, which is very rules driven. I would describe that as a do no harm proposition. If you were looking at a 1 through 5 scale in terms of something being responsible of the ESG characteristics, it probably fit boxes 1 or 2. So the title there is definitely rules-based approach, something that's very easy to document, easy for the client to understand exactly what they're getting. There are some exclusions. There's a link through MSCI to data mine to ensure you've got the right characteristics of stocks inside those portfolios. And then, as mentioned, there's a growth fund range. So the fund range is a CEDO-coded version, a unitized version of the passive MPS. There are a few subtle differences in terms of what's available inside. So clearly an MPS is a portfolio of different funds, ETFs, whereas the fund range can invest directly in gilts, and that's a cost saving. So it's extremely useful. The growth fund range is listed in a significant number of different platforms. If you think about the reducing capital gains tax allowances that clients now have been able to control their withdrawals to make ISA contributions, for example. So think of somebody with a GIA and a general investment account, an MPS solution in there could trigger unintended consequences in CGT. Now the allowances are quite small, whereas a CBEL coded version definitely puts you, the financial advisor firm, in control. If we move on to what we do in the income space, on the left hand side there you can see a range of income solutions. So 2 risk profiles. The risk profiles aren't risk targeted. It's very much a solution that targets yield rather than that targets risk. But a rough expectation will be somewhere around the mid-risk profile, so somewhere that's currently around 50% equity, so about a DT5, and the income and growth solution, which is designed to aim for the similar yield target, but with a little bit more of a growth bias towards it in order to combat inflation and value over time. So you've got 2 income solutions, 2 different risk profiles, but 3 implementations, so a passive version, an active version, and then again a CDOL coded version to help with those general investment. On the right hand side, there's something that is gaining significantly more traction. So certainly as the regulators send in reviews out to firms about how they construct their CRP, their centralised retirement proposition, having a solution that's bucketed, so that's got different assets for different timelines, and then as you can see at the bottom, it's trying to combat sequencing risk, which is something that I'm sure you'll have been made aware of, certainly since probably the late 2000s, 2008, 2009, post-financial crisis. There's a lot of talk about sequencing risk there. So this approach is bucketed. Start from left to right. Short-term cash, there's a 10% cash return. I want you to think of that as having somewhat of a cap and collar approach. So 10% cash. If it falls to 4% cash, we'll take action, and that's the trigger point for us to take action. The aim would be that it wouldn't get hopefully down to 4% cash, because the 2 solutions on the right, the medium term bucket and the longer term bucket, are both targeting yield. Current yields on those portfolios as it stands, so the anticipated yield for the coming year, 4.68% for the medium term bucket, 5.32% for the longer term bucket. So you can see there a combination of around 5%. That gives us, I suppose, cash available in the first year to an investor of circa around 15%. So you've got 10% holding and this 5% yield that's topping that cash up naturally. Why 10% in cash? Think of it as an anxiety trigger. So the client probably will end up in a position where if they see the turn on the news and the market's fallen, their anxiety levels are going to start to increase. They haven't got the earnings capacity to put the money back into that proposition. So therefore what they've got is what they're very reliant on. And the idea of the 10% cash is to do 2 things. It's to hold them through a peak to trough market cycle of the market having fallen and then rebounded. So in other words, using time as an ally. And secondly, and I think probably just as importantly, the unknown. So the client comes to you probably at the worst time, because that's the way that the world tends to work. They come to you and they say, "Hi, Mr. IFA, Mrs. IFA, Miss IFA, Miss IFA. I need to take a capital withdrawal from my retirement account because I want to do X, Y, and Z, whatever that is." And sod's law, I guess, suggests that timing of that will be when the market's depressed. And you then have probably a combative conversation with them about why it's not a good time to do it now. And they say, "Yeah, but pension freedoms and all that kind of stuff. I want to take this withdrawal." So this way, we've got this cash buffer for the unknown, and as an anxiety corrector, if you like, something to say it's okay, you don't need to panic, you've got plenty of cash to cover you for the short term. So like I say, we're seeing increasing conversations around that on an almost daily basis. So commitment and cost. I think we have a healthy obsession with cost within the AJ Bell investment team. So if we start from the top in terms of the fund solution, so MPS 1 to MPS 6, so 6 growth portfolios that we spoke about earlier. You'll see underneath MPS 1 it then says cautious, moderately cautious and balanced. That's the VT, so value track CDOL coded names are VT cautious, VT moderately cautious and balanced. Fund charges capped at 31 basis points, so quite a nice story there in terms of value to the end retail client, the end consumer. The solution started life at 50 basis points. They're now 31 and capped at 31. And that is a commitment on cost. So as we've been able to grow those funds, and the cost of hosting them as a CEDO coded entity proportionately is reduced, and we've been able to access different share classes, then the price, the underlying costs of those portfolios has fallen. And as it's fallen, that cost saving has been passed on to the end client. So quite a good story. Started life at 50 basis points and now 31. And hopefully there'll be another station along that journey where, you know, the fun train, so to speak, will stop, and therefore we'll be able to reduce those costs down over time. We then move down to the passive MPS. Passive MPS comes in at 28 basis points. So I suppose you could say that the difference between the passive MPS and the fund range, why the slight reduction, that's down to the VT hosting. So the fact that these aren't CEDO coded. Then we're into the active portfolio. So active MPS graduated based on the underlying assets inside. So if you're starting with something that would be in the DT3 box or de facto 3 box, you're looking at 58 basis points all the way through to around 90. Worth mentioning that at this point, our fixed costs, so our costs are fixed at 15 basis points. So you pay us 15 basis points for strategic asset allocation, tactical asset allocation, fund research, etc. And these costs are included in that 15 basis points. So often people say, oh, so the 15 basis points is on top of the passive MPS. No, it's included. So look at passive MPS as an example. MPS 1 course is 28 basis points. 15 of that is for our management and 13 of the underlying. So that's the total price. Then we go to active, so 51 through 68, and then the responsible range. So again, the responsible range being utilising MSCI's data, and then giving you this do no harm approach. So again, a low cost proposition. Great news, I guess, in terms of the availability on platform of the MPS and fund solution. So the funds are largely available on a significant number of platforms now. I don't think there are many that we haven't managed to get the funds listed on. But the MPS solutions across obviously Investcentre, Aviva Culture, Aberdeen, Hubwise, Transact, and Morningstar, and a growing engagement with different platforms to try and get the solution listed. You'll notice the retirement portfolio is only listed within Investcentre. That's because the smart rebalance approach. So, said before, with this 4 to 10% cash buffer, if the cash holdings get to 4%, then we look to top the cash up, and we do that through what we refer to as a smart rebalance. So that's taking capital from the medium or long-term bucket, whichever has the highest capital value, thus helping to reduce sequencing risk as well. In other words, we're trying to top the cash up from the solution that's performed the best. So taking account of decisions that were made at the start of 2023 for the strategic asset allocation review, this was largely driven by interest rate change and bond yield change. So you can see there that the equity content in portfolios was reduced. Largely that was a swap between equities and high yield bonds. The long-term return on equity and the long-term return on the yield on high yield bonds had sort of narrowed. At the start of the year, high yield bonds were around the 8.9, 9.1% mark. Long run expectations on equities probably around 7.5 historically. So it's in a quite a common sense swap to remove some equity in favour of bonds. Cash up, so the cash holdings have rose significantly. Probably worth noting that we view cash as a zero duration bond, so kind of about a barbell approach to managing duration. So if we just go through these sort of piece by piece, the efficient frontier flattened largely because yields rose in the lower risk portfolios, cash holdings rose. The deal that we get with BlackRock Sterling liquidity is over 4% now on cash. So you can see that those lower risk portfolios have got a higher return profile. And again, equity weights reduced, particularly US. A lot of that's conversations around their levels of debt. Our duration moves slightly higher, but again, it's still low, still quite low risk in terms of interest rate sensitivity and the unknown inflation. Although, as I speak, yesterday inflation was reported having fallen. I'm still not quite sure where that direction of travel is going to go. Alternatives, so UK property was added to replace infrastructure. I suppose the metric there is at the start of the year, the P ratio on property was sub 4 and infrastructure was over 18. So in terms of managing risk, it was seen that everybody was buying infrastructure, largely because they wanted inflation protection. The inflation protection nature of infrastructure and those contracts are because the long term. We looked at that and thought, well, we've done quite well, Avi, thanks very much. It was one of the best performing asset classes in 2022, amongst obviously quite a torrid year for investors. So we looked to swap those out largely based on valuation and won't dwell too much on MPS performance, but you can see their annualized returns all quite graduated. So you've been rewarded largely for the risk that you're taking, and extremely consistent. So we pride ourselves on that performance being consistent and easier for you to use this as a proposition that fits into cash flow modeling tools and is looking at client outcomes and hence reference to the award. So we won't dwell on these too much. But passive performance, as you can see on screen, managing downside risk over the last year quite nicely. Same in the active proposition, again managing downside risk, and particularly for those low risk investors in the last year very well. Annualized returns looking quite healthy and again quite graduated in terms of risk taken. The MPS performance for passive, obviously a blend of the two, and then the fund range. So fund range probably has been one of our biggest growth engines in terms of assets that we manage over the last 2 years. And you'll have seen articles in the press, so we've got favourable mentions in from independent press resources around performance. Okay, so where do we sit now? So that's as of the 31st of August through September. The 1 year numbers actually picked up to first and second quartile, but really we're looking at the longer term nature. You can see they're right across the board, from top to bottom, the 5 year annualized performance all ranking in the first quartile, which is pleasing to see from our perspective. I'm sure yours, some of you no doubt will be invested in these solutions already. And again, the 3 year annualized first and second quartile performance, which again is pleasing to see. And it's that consistency, I think, across the different risk profiles that IFAs are certainly taking note of. I spend quite a lot of my time talking about the range of expected returns. I think it's something that in the main firms are bought into. So I'll give you a quick summary of what this is. I refer to this often as a dispersion of return charts. In other words, from left to right, as I take more risk, I expect to make a healthier return, but I accept that maybe there's a little bit more downside available, which is represented in the grey shading. It's worth noting that we try and take we take away from a modelling perspective the best 10 years. So if you think of 100 years of outcomes, we take away the best 10, expecting that those would be largely unpredictable. It's unlikely that you're going to get a return profile that's in the best 10 out of 100, so the best 10%, and we take away the worst 10. Now, clearly in 2022, we got what we described as a 1 in 100 year event, but we still managed to manage that downside really well. So the coefficients for these portfolios in 2022 were a downside of 3.9 on the lowest risk portfolio. So on the left hand side of it now says 1.8. Last year's vintage, if you like, for 2022 was 3.9. We managed that quite well. At worst, we were down 5 against a modelled, excluding those 10 worst years at 3.9. I wouldn't mind pointing out to you at this point is these are long run expectations, but they are data driven. So the component parts of those portfolios make up these numbers. So again, start on the left hand side is probably the easiest. The anticipated return long term is 5.9%. When you think that high yield bonds are at sort of the upper 8s, low 9s in terms of yield, cash is yielding us 4.4. These return profiles become a little bit more tangible and easier to understand if you start to factor in what the yields are on the assets that are building these portfolios. And again, people looking at saying, well, I could be investing in cash, and maybe cash is going to pay me somewhere between the upper 4s or the low 5s, depending on the time that I commit my money for, or national savings recently coming out at 6.25%. Clearly, they carry some reinvestment risk. So when that fixed rate deal is finished and if interest rates have then gone back down, which I think everybody expects them to do over the course of the next year or two, what will be the risk that that investor then takes to move away from cash? It'll be what cash is available. If that doesn't look appealing, then the risk that goes, I guess, is that reinvestment risk. Where do they go next? Whereas these return profiles of people investing now in 2023 and what their long-term expectations are. So your average balance investor, you know, is going to be looking to enjoy a 7.5% average return over time, provided they stay invested long term. There's a very strong message available using this slide. It's available within the documentation that we produce in the advisor FAQ, so it's readily available online on the investment website. So the portfolio outlook, I think it's fair to say that over the months ahead, it still look quite challenging and uncertain. There's going to be some short-term buffering along the way, but you know, just like the message that you have to end consumers, the idea is that you invest for the longer term and you try and get the client to focus on the longer term. Our message is perfectly aligned with that. Let's not get too hung up with being buffeted with short-term market movements. Let's think about that long-term approach. At the bottom it says with no explicit tactical positions. So looking for asymmetric opportunity or risk within the market. Currently there are no obvious asymmetric risks, so there's no obvious direction of travel for interest rates yet. And there are no significant positions. So we spoke a little bit about trying to take long-term opportunity out by investing in property and avoiding infrastructure. Same with high yield bonds. You could argue that they're tactical positions, but there's nothing that's sort of glaringly obvious. The energy position that we had a few years ago that did well and doubled in value that we sold in January, there's nothing that sticks out currently like that. But you know, rest assured, we're on the lookout for those when they arrive. So I guess in summary, some strong AUM growth, focused on cost reduction, so low cost and the scale available. A continued focus on reducing that cost where possible. And certainly from a performance perspective, the performance has been good. It's managed downside very, very well. It's within the expected limits and it's been consistent. So it's that consistency of performance and that managing downside risk that really helps us grow the AUM over the last couple of years. And again, competitive in terms of charges and performance within the peer group. Okay, that's all from me. Please do take time to fill in your feedback form, and if there's things that you'd like for us to cover up in the future, then please, we'd love to hear that and try and provide for you in these sessions the topics that you're looking for. Thanks very much.
Thank you, Andy. We'd like to hear more about the range and managed portfolios we offer. Please let us know on the feedback form at the end or in the note in the chat box, and we'll come back to you and pick that up. Thank you. Our final speaker for today, last but not least, a firm favourite from our tour, and if you've not already seen Lisa present in person or offline, where have you been? This is a very useful session, was rated very well in our in-person events, and addresses life after the lifetime allowance. Lisa will examine how pension lump sums and death benefits will work in the new pension world from 2024. And we'll look at the portion for which clients are in protection and discuss planning points under the new regime. Definitely a session not to be missed.
Hello and welcome to this session on life after the lifetime allowance. So we had a bit of a bombshell, I think it's fair to say, back in March with the budget announcement. I don't know about you, but it certainly came as a bit of a surprise to me, and I think most of the pension industry. The fact that the lifetime allowance was going to be abolished completely. We'd heard rumours that it was going to be cut, but it going completely was a bit out of the blue, and certainly without consultation with the industry. So we've got a lot of changes coming about. We've had lots of questions on it. I'm sure you've had lots of questions about it too. So really, yeah, the idea of this session is to go through what we know so far in terms of what's happened now and you know, what's going to happen in the future with the lifetime allowance. So I'm going to start off by just having a bit of a recap of the rules for the current tax year. So you know, it's a gradual process that's happening. So we've had a set of rules coming this year. We then will have another set of rules that come in from April 2024 and beyond that. So we'll look at what we know some of the information that we have already about that, what that's going to look like. I'll talk about protections a little bit, so what the impact is for clients with protections in the new world, and then I'll look at some of the questions that we don't know the answers to yet, which there are a few. So yeah, just to acknowledge, I'm sure there'll be things you're getting asked, and certainly things we're getting asked that we don't know yet. So kind of trying to determine what we do know and what we don't know. So a bit of a timeline to start off with then. So it all started in March with the budget announcement. Obviously, there was lots of headlines about it, but the lifetime allowance is being abolished, swiftly followed by Labour standing up and saying if they get into power, they'll reintroduce it, which obviously makes life more interesting as well. See, what we're talking about today is really, how it is going to be removed, dealing with that might impact how, if ever, they did bring it back and whether they actually will. I think there's still some debate about that, really. But anyway, yes, so we had the budget announcements in March, and then it was about a week later we had our draft finance number 2 bill for this year. So this is where it set out the rules, which then came into play from 6th of April this year. So finance bill came into effect from the 6th of April this year, although it didn't actually get royal assent until the 11th of July. So, we had a bit of a temporary period where we were working off draft legislation for a few months, and it could have been subject to change. And there were a few sort of minor tweaks around the edges, but nothing major. But it is fixed now for the position for this tax year. So I'll go through what it is, what the situation is for your clients who are crystallising, taking benefits this year. We then, on the 18th of July, we had our first look of what really life after the lifetime allowance looks like, will look like from April next year. So this is some clauses that were released, which will go into the next finance bill 2024. It's not all of the finance bill, it's only the bits relating to the removal of the lifetime allowance, and it is not all of them, it is just a bit of it. So that is open for consultation. Maybe by the time you're watching this, it might have closed, but it closed on the 12th of September. This consultation on the draft clauses. So that's as I'm recording this now is what I'm looking at. We're in this consultation period. So the rules that I will go through about what we know from these draft clauses are still subject to change. And as I've said, then by no means complete. So we are expecting further legislation to tell us a bit more about the rest of the rules, the bits that are missing. Possibly November. We think it might come out around then. It's not set in stone. And then, there'll be a consultation on that, and then we should get a finance bill usually around March time, which should be the complete finance bill, which isn't really very far ahead of the changes, which are all meant to come in April 2024, is an implementation date for these new changes around the removal of the lifetime allowance. And again, still will be a bill, so there could be little tweaks in it right up until it gets royal assent, which is normally do it in July, just before the summer recess, where it's then definitely and not going to get changed until they make some new legislation. So we'll start off then by looking at, say, the situation for the current tax year. So this might be a recap for some of you, I'm sure, but just a quick sort of reminder, if you like, of what's happened. Because of course, when the budget came out, it was very short notice for from middle of March until the 6th of April. The intention's always been to remove the lifetime allowance, but there just simply wasn't enough time to do it. So we've had these temporary measures in place effectively for this year. So not massive changes in terms of the process and what goes on around benefit crystallisation events. We still have our lifetime allowance in place this year, frozen at the level of £1,073,100. We still have maximum PCLS payments of £268,275 for anybody who doesn't have protection. We still have our benefit crystallisation events, and we still, as a provider, we still have to issue BCE statements when somebody takes their benefits. So the process that we go through hasn't changed at all. So we still need to ask clients about their previous lifetime allowance usage, and we still have to ask them if they've got any protection and for evidence of any protection when they come to take benefits. We still have to do all the tests. We still have to do age 75 tests, though given the fact at the end of all that process that we do, the same as we've always done, there is no lifetime allowance charge. So part of it might seem a little pointless, especially to your clients, that that we have to go through this process, but at the end of it, there's no charge. However, when we come on to sort of look at the rules for next year, there is maybe a point still why we have to have statements and things, why we might still need to know this going forward about what benefits people have taken previously. I say this is all law now in the Finance Act, which has now got royal assent for this year. Now, there's no lifetime allowance charge, say, in the current year, but there's a little bit of a caveat on that. So anywhere that we had the 25% lifetime allowance charge previously, that has gone. So that was really when people are taking income. So most common one will be people, certainly for us in SIP World, people who are using funds in excess of the lifetime allowance for drawdown. So basically, that's where we used to have the 25% lifetime allowance charge. The funds would remain within the pension, but when they come to take it, they pay income tax on it. That 25% charge is gone now. They just pay the income tax when they take it out. So age 75 is the other one, is the main one on this as well. A lot of people would only designate funds to draw down up to the LTA before 75. Obviously, some people did the excess before that, but not always. But you couldn't avoid it by 75. So, quite often on age 75 tests for those in excess of the lifetime allowance, we would have to deduct the lifetime allowance charge from their fund and pay that across to HMRC. We don't have to do that in the current tax year, so that is fine. But where it's the slight caveat is with where a 55% lifetime allowance charge would have applied previously. So these are the ones where it was paid out as a lump sum, because obviously with a 25% lifetime allowance charge, it was still within the pension, and they would then still pay income tax on the way out. Whereas with a 55% lifetime allowance charge, that was it. There's one tax hit, which is why it was a higher rate, because there wasn't income tax as well. So in the current year, basically anything above the lifetime allowance taken as a lump sum, you don't pay the 55% tax charge, but on the bit above the LTA, you now pay income tax on it. So in the lifetime, that would be a serious ill health lump sum. The more common one would be the lifetime allowance excess lump sum. So if you take that as a lump sum now, you just pay income tax, but if you take it as drawdown in our world, you just pay income tax. There's not really much difference on that. And then, uncrystallised funds, lump sum death benefits. So you've got the death benefit ones as well. So the death benefit, it'll be subject to income tax in the hands of the recipient, and so the beneficiary who's receiving it, if it's above the lifetime allowance. In those cases, the scheme administrator would still pay it out in full to the beneficiary. They would report the fact it was over the lifetime allowance to the personal representatives dealing with the estate. They'd tell HMRC about it. HMRC then go and get the income tax directly from the recipient of that lump sum death benefit. In those cases, probably not that common, but certainly not crystallised funds one in DC world, maybe a bit more in DB, you might get some on that. The other change for the current tax year is around when we look at protections. So if you've got clients who've got enhanced protection with protected PCLS, there are some changes on this. So if the protection was in place on 15th of March 2023, the date of the budget, technically it's whether it had to have been applied for by that date. If it was later received, that's fine, but with enhanced protection, you've probably had it for a very long time, as it's going back to 2006. For these people, so your clients that hold enhanced protection, big difference is now from 6th of April this year, they can now make contributions. So obviously they can't have made contributions in the past because it would have broken protection, any contributions that they've made since 6th of April back in 2006. So they've had a long time where they couldn't contribute. They can now contribute, and they will still retain their right to protected PCLS. whatever it says on their certificate on there. However, there is a cap on this. So the PCLS is capped at the maximum that was available on 5th of April 2023, and that is regardless of whether they contribute or not. So I guess they've done this so that, you know, people in this situation can't suddenly put lots into their pension. You know, if they are still working and they've got the earnings to support personal contributions, or they've got an employer that can make contributions, obviously they'd have maximum carry forward available because they can't have contributed for years, that they can't just put it in and then get more PCLS as well. But it does apply regardless of whether they contribute. So I think the only sort of real losers in this would be if somebody had enhanced protection with protected PCLS and they come to take it in a couple of years' time. They've not made any contributions. Before these rules came along, they would have been able to take their protected amount, the protected percentage of the whole fund, whereas now it's only the maximum available at 5th of April 2023. So basically, they're not getting the PCLS on any growth after the 5th of April. So an example on this one, let's say you have somebody had lump sum protection of 30%. Their 5th of April value was 1.8 million. Their max PCLS entitlement now is capped at 30% of that 1.8 million, so 540,000. When they come to take their benefits, the max PCLS will be the lower of whatever it is they're crystallising, and 540,000. So, you know, if their fund value was £2 million when they came to take it, they'd only be able to have £540,000 PCLS, whereas before this rule change, they would have been able to have 600,000 if the fund value was 2 million, and 30% of that. So there is a change on that. But as I've already said, yeah, the entitlement remains whether they contribute after 6th of April or not. Another change is for those people with fixed protections, any of the versions of fixed protections, so long as they had them in, well, I've said it here, in place on 15th of March 2023, but again, it could be because applications are still open for the latest version of fixed protection, so fixed protection 16. You just have to have applied for it by the 5th, have your application in before 15th of March, and if it's granted later, it still applies. Basically, for these people, they can now contribute from 6th of April again, from the start of this tax year, without impacting their PCLS. So that's quite a big change. You're going to have people, probably more people with fixed protections who haven't started taking benefits. You are people that can, and they're more likely to be younger and still working and still have the ability to make contributions, that they can now do that without impacting their PCLS. They will still keep their protected PCLS going forward. This is particularly good news for people who've got divorced. If you have any clients who have enhanced or fixed protection, who have had a pension sharing order applied to their pension, so it has reduced the value of their pension, but you know, it's not reduced, you know, the fixed protection to the point that they've lost it, so they still have fixed protection, you know, but their fund values have gone down. But they can now rebuild their pensions, they can without losing their entitlement to a high level of PCLS. So yeah, that could be one, if you have anybody in that scenario, worth looking at. So PCLS calculations, I've said PCLS calculations remain the same for these people. Just a little look at what I mean by that. So this is where people had protection in place, already applied for it by 15th of March 2023. But anyone that had enhanced protection but didn't have lump sum protection, their PCLS will remain as the lower of 375,000, which is based on the old 25% of 1.5 million when the LTA was introduced, and 25% of the amount crystallised. But they can include any contributions post 6th of April 2023. So the cap of 5th of April 2023 value for PCLS only applies to enhanced protection with lump sum protection, doesn't apply to anything else. So yes, if somebody's fund value is less than 1.5 million, you know, they could build up to that value and increase their amount of PCLS. Fixed protection 2012, because that was based on 1.8 million, so the PCLS maximum on there is 450,000. Fixed protection 14, again based on 1.5 million, so PCLS is 375. And then finally, the current still open, the fixed protection 16, PCLS will be the lower of 312,500, so that's based on the 1.25 million and 25% of the amount crystallised. And again, you know, if people have got lower fund values, you know, you might have FP 16, you know, your fund value might be 1.1 million, you know, you've got a bit of headroom there, you can put it up, make contributions now, get it up to the 1.25 and then have a higher amount of PCLS available on that. In terms of other protections then, so basically primary protection and the individual protections, there's no change in the current tax year because you were always allowed to make contributions with these. That didn't break it, so that's still the same. Your PCLS payments are still the same as they always were. So for your individual protections, it's 25% of whatever your protection amount is, and primary protection is based on 1.5 million, so 375,000 if there's no lump sum protection with it. Yeah, so they stay exactly the same as they are now. So there's no change on those ones. So that's where we are for the current tax year. Looking forward then to what happens from April 24, which is when the lifetime allowance is actually going to be removed. At the moment, it's just the lifetime allowance charge that's removed. So the proposed revisions that we've had out then is we had 41 pages of draft legislation come out, and you know, just on removing the lifetime allowance, which gives an idea of the size of the task. Also, the fact it's not complete. So anything I'm going to say to the end of this session when I'm talking about what happens next year, it is all still draft. It is subject to change. So that's me saying, don't hold me to it. There are definitely parts of it which I think won't change, and there's little bits around the edges kind of stuff which may be subject to change. The basic concept is that under this new regime that we will have, only lump sums are going to be tested. There are no tests, no benefit crystallisation events that apply when you take income. So taking drawdown, bang annuity, taking the scheme pension, no age 75 tests, all of that will disappear. You only get tested when you take a lump sum, either in the member's lifetime or if a lump sum is taken on the member's death. That is the only time where we're going to have tests applied. But we are going to have 2 tests, and we have 2 limits instead of 1. So let's have a look at those. So the first limit that we will look at, which is the lump sum allowance. So we're going to have an LSA. So of course, with new regime, we have new jargon for you. Now, the amount of the lump sum allowance looks familiar to you all, I'm sure, 268,275. So it is the same as the PCLS limit currently. There is nothing in the draft legislation to suggest that that's going to rise. It's not linked to inflation, it's no indexation or anything. It's just a fixed figure in the legislation. When an individual takes a lump sum in their lifetime, this will be tested against the lump sum allowance. So PCLS is the most obvious one. PCLS will be tested against this allowance. If somebody takes a UFPLS payment, or crystallised funds pension lump sum, then it's just a tax-free element that is tested. It's also the tax-free element of other lump sums, so trivial commutation or winding up, so less common, but you know, it's there in the legislation. That's tested against this. The exception, the only lump sum that you take in your own lifetime that's not tested against this would be a serious ill health lump sum. That's treated differently. But all the other lump sums are tested against this allowance, and it's just the tax rate element that's tested against it. Any excess taken above the lump sum allowance, when you get over the 268,275, you can still take it, but it's going to be subject to income tax on that. The second allowance that we have, and the next bit of jargon, is the lump sum and death benefit allowance. So we have an LSDBA, LSA, LSDBA. The LSDBA, again, is probably a figure that's quite familiar to you, is 1,073,100. So when somebody dies and a lump sum payment is made, then we test against this, but we have to also, any tax-free lump sums taken in their lifetime, which have already been tested against the lump sum allowance, are tested again against the lump sum death benefit allowance. which I've got an example which explains it more clearly. Serious ill health lump sums are tested against this. So that's the only one in the lifetime, and then it's any lump sums paid on death. And anything over the limit, once you've used up your LSDBA, any payments above that limit, lump sum payments above that limit, are going to be taxed as income on that. So I'll show you a little case study which explains it a bit better, I think. So here we have John, who's 65-year-old. He's got a bit of DB and DC pension benefits build up. He wants to start taking a scheme pension at 65, so he decides to do that, £12,500 a year, and he takes 37,500 PCLS. So we have to do a test now because he's taking a lump sum. So we have these two allowances, the lump sum allowance and the lump sum death benefit allowance. So the 268,275 and the 1,073,100. When he takes his lump sum, it is tested against both of these. Now, that's what it says in the legislation, that you definitely test against both of them. In most circumstances, you're never going to use your LSDBA up if you're going to use your lump sum allowance up first before you use up your lump sum death benefit allowance. So it kind of seems a little pointless in most circumstances why we're testing against the LSDBA in the lifetime. I can say the only exception is for serious ill health lump sums where you use it up. But apart from that, it's really going to be the lump sum allowance that you're concerned with at this point. So he takes 37,500, so that's used up his lump sum allowance. Some of his lump sum allowance, he's now got £230,775 left for taking future benefits, future lump sums. And when he dies, he'll have £1,035,600 left for any lump sum death benefits to be paid out. Important point to note here, the fact he's taking scheme pension, that does not get tested at all. A couple of years later, John now starts looking at SIP, decides to take his PCLS from his SIP and to designate the rest to draw down. So again, we'll look at his lump sum allowance. So we had 268,275 is the standard lump sum allowance to start with. He's used up at age 65, he's 37,500. He now uses up another 150,000. So he's got a balance of £80,775 left. We also, if we look at his LSDBA, it means when he dies, his LSDBA available is 885,600. And again, the important point here, as you notice, there is no test for drawdown. The point he designates it, there's no test. The point he starts taking the income from it, there is no test on that. He dies a few years later, age 73. He's got a drawdown fund value of £560,000. When we look at paying out lump sum death benefits, we don't have to worry about the LSA anymore. LSA is only in the lifetime. So now we are just looking at the LSDBA. So it starts off at 1,073,100. He's used up some of it at age 65, taking his first lump sum, a bit more at age 67, taking his second lump sum. He's now got death benefits. If this is being paid out as a lump sum, that's 560,000. That's still within his available LSDBA. So there's a bit left over. So his lump sum death benefits can be paid out tax-free. He's died under 75, he's within his LSDBA, that can be paid out tax-free to his beneficiaries. Right, I will come on to talking a bit about taking benefits as drawdown in a minute, a bit later on. We're just doing with lump sums at the moment. PCLS, so we've got this limit overall that you can have within your lifetime, your lump sum allowance for your lifetime. But when it comes to the actual rules of how you take a PCLS, so at the moment, we have this idea of, you're taking 25% of the amount crystallised, and we always think of it as 25% tax-free cash. This is all kind of reworded a bit in the new legislation. In practical terms, in most circumstances, it won't make a difference. But I'll come on to a few bits where it might. So the basic idea is no liability to income tax on a PCLS up to what's called the permitted maximum. And then the legislation states the permitted maximum is the lowest of the applicable amount, the available LSA, the available LSDBA. And the applicable amount is a third of the amount you use to provide the income. So in SIP world, it's a third of the amount you put into drawdown. So instead of being 25% of the amount crystallised, the new wording is it's a third of whatever you put into drawdown, the third of that is your applicable amount. So if you put £75,000 into drawdown, you can have £25,000 is your applicable amount for PCLS. And then because the permitted maximum is the lowest of the applicable amount, your available LSA, available LSDBA, you know, as long as you've got £25,000 of LSA left, then you can have that as your PCLS. So in practical terms, that works the same as it is now. It's just it's kind of phrased differently. Same if you're doing an annuity purchase. There's an equation in the legislation for scheme pension, but it's broadly the same concept on that. So effectively, it's still 25%, but it's a third of what you use to provide a pension up to your LSA. And then say the LSDBA won't be applicable in most times. That won't be the bit that you're limited by. But what's interesting on this is that anything above this permitted maximum is allowed, but it's subject to income tax. And that's quite a change from the current rules. Basically, if you overpaid PCLS previously, it would normally be, I mean, to be honest, it would normally be an error. And, you know, if it's a genuine error, there are ways, you know, you can put it back without having any horrible tax penalties. But if you didn't, and you know, a scheme administrator just overpaid PCLS to somebody, anything that's over the allowed amount, the permitted amount, would be an unauthorised payment. And so you'd be looking at an unauthorised payment tax charges, obviously, which would be quite penal. Whereas in the new regime, it's just subject to income tax. So that's not really a big penalty. And if you're looking in DC world, it probably doesn't make that much difference, because you could obviously, under flexi access drawdown, you can take as much as income as you want. So whether you took it as, you know, a taxable, because you've had a bit more PCLS taxable as income, or you just took it as drawdown as income, it's subject to income tax, anything that's above this permitted maximum. So it doesn't really have a massive impact. When you start looking at DB, this is quite a big change, because all of a sudden DB schemes can now pay potentially unlimited PCLS. Just if it's above the permitted maximum, it's subject to income tax. Now, obviously, a DB scheme previously didn't have that ability. It was either PCLS, which was tax-free, or you're using it to provide a scheme pension. You know, you couldn't take other kinds of lump sums from your DB scheme. So this is one of the things which potentially I think could change when they have the feedback from the draft consultation, from the consultation on the draft legislation, but we'll see. So let's have an example where somebody had a DB scheme, a relatively small DB scheme of say £80,000, but they had a reasonable size, a decent SIP or the DC pension of 1.2 million. Now, under current rules, you know, they couldn't move their DB scheme without taking advice on that, if that was the right thing to do or not. They would only have the option of having a scheme pension from that. They could have a bit of PCLS from it if they took that first before the DC, but they could, so they'd have the, you know, they couldn't take it as a lump sum, basically. You know, they had to use it as a scheme pension. So whether or not they took any PCLS from it, you know, it's going to be quite a small scheme pension they're going to get out of that, you know, year on year. But, you know, they've obviously got other pension savings, they've got a decent sized DC pot. But as the draft legislation stands, it looks as though they could actually, if the scheme allowed it, they could commute all of their DB pension for a PCLS payment. Now, the permitted maximum was the lower of a third of the amount that you use to provide a pension, and your available LSA and your available LSDBA. So if you don't use any of it to provide a pension, to provide a scheme pension, then your permitted maximum effectively is going to be zero, because you can have a third of nothing used to provide a pension is nothing. So the lower of nothing, you know, your LSA, your LSDBA is nothing. So basically you couldn't have any of it as tax-free cash. but you can still have it under the new rules as a PCLS payment. It would just be subject to income tax. But when we do these tests about people taking lump sums and using up the lump sum allowance, it's only the bit that's not subject to tax that uses up your lump sum allowance. So doing that, taking the PCLS but was subject to income tax, wouldn't use up your LSA. So you could still, because you've got a big enough DC pot, you can still get your full 268,275 PCLS out of your DC pot. So you haven't actually lost anything. You're not lost in that scenario any PCLS, because you can just take it from your other scheme. So actually might not be a daft idea to do, rather than taking a very small DB scheme, scheme pension. I'm not sure that's the intention of the rules, but it could be a consequence of them. And obviously that negates the need for getting advice to access your DB scheme. If the above £30,000 you need advice, and all the safeguarding things that they put in place around DB pensions, that kind of circumvents it. So that's why I think it might change, because it just seems a little bit odd. I mean, the other scenario is actually that first one, somebody's quite comfortably off, if they've got a decent sized pension fund, is actually somebody who's just got a very small DB scheme, but it's over the limit, so they can't transfer it without taking advice. That actually they may just decide, rather than having a very small scheme pension paid for years, I'd rather have it now, even if I take the income tax hit and I use the bit I lose the PCLS on it, but actually I can get it now and I don't need to take any advice on it, because I can just tell the scheme to give it to me all as a PCLS. So yeah, it's a bit of an interesting one. And the other point on this is a bit of an anomaly as well, because you take PCLS, it doesn't trigger the money purchase annual allowance, so it doesn't restrict obviously paying in the future. Whereas if you took it, it's a flexi access drawdown and PCLS, then you would trigger the MPA. So there's a few sort of implications with that one, which kind of makes me think it could change, but it is an interesting one, I thought, anyway. So moving on to a couple of the bits around PCLS. One of the questions we got asked quite a lot when just after the budget, when it all came out to start with, is that if PCLS is a monetary amount, if you don't take it all out, if you've got DB and DC scheme and your DB scheme pays out less than 25%, can you make it up by taking a higher level of PCLS in your DC scheme? Does that work? And the answer is, it depends. There are certain circumstances where we will have more flexibility going forward looking at the rules. So I'll give you a couple of examples on this. Let's say somebody's got DB, DC, both £800,000. Under current rules, your choices are either you take your DB scheme first, take your max PCLS 200,000 on that, then you've got 68,275 PCLS left for your DC, or you can switch it around and do it the other way around. But quite often we find people want to take the PCLS, would rather take the PCLS from the DC scheme because the commutation factors in the DB. So you might find people would have to take the PCLS from the DC even if they didn't really want it, just because they're going to start the scheme pension elsewhere. Might not be actually really the best thing for them to do, but otherwise they'd lose out with the commutation factor. What you will be able to do under the new rules as they stand is commute just enough to get your 68,275, so you don't lose it in your DB scheme, and you'd still have your 200,000 in your DC scheme. And this is because it's only the lump sum that's tested. So the fact you're taking scheme pension doesn't get tested at all. So it does give you a little bit more flexibility. Next one on here, DB 1.2 million, DC 400,000. If you did your DB scheme first, say you would take all of it from that, there'd be nothing left for DC. If you did your DC scheme first, you would take your 100,000 and have 168,275 left for DB. But under the new rules, you could commute just enough to get what you needed from the DB scheme and still have the 100,000 left in the DC. So there is a bit of flexibility with this. You have to have the right fund sizes or whatever, things for it to work, but there is some flexibility, and it all comes down to the fact because your income, you're taking your scheme pension, isn't tested. So in the past, you'd have used up lifetime allowance, which would impact your PCLS available elsewhere, whereas going forward, it won't. I'm just going to skip in the interest of time. Another example. Okay, so protections then. Protections from April 24. There is a bit on the protections in the new draft legislation, but without going into all the minute detail, the broad concept is they continue as they are now. So in most cases, there are a couple of exceptions which I'll come on to, but basically, if your clients have got protection and so therefore they have a higher entitlement to PCLS, that will translate, their lump sum allowance will be increased to whatever their current protected PCLS is. So that will be enhanced on there. So that will replace it at whatever level it is that they hold. And then the lump sum death benefit allowance will be increased to the amount of their lifetime allowance protection. So, you know, if you've got fixed protection at 1.8 million, that's what your LSDBA will be, or 1.5 or 1.25. That's what that will be. They have now put a closing date on FP16 and IP16. So they're going to close on 5th of April 2025. Now, so you can still apply for them, and that will give your clients a higher level of protected PCLS. However, if you make applications after the 15th of March, as in the date of the budget, really important to remember, these people can't make contributions. So to apply for FP16, you still can't have made contributions since April 2016, and you cannot make them. It's not as good as people who've always had it, who've had it in place already, that can now contribute. It is different. So that's quite a key point to consider when it's you're thinking about applying or not. The main exception then on enhanced protection for the protection changes. So people with enhanced protection, their lump sum death benefit allowance is not whatever their fund is, in the way that, obviously enhanced protection protected you completely from the LTA. It will be restricted to the 5th of April 24 fund value. So I think obviously they've done this is because these people can now make contributions, that people don't just like put loads and loads in their pension and then, it's completely unrestricted. So yeah, it is restricted to the 5th of April 24 fund value. There's another little bit of an anomaly in the draft legislation, which says the PCLS for primary protection, where you don't have any lump sum, is increased by the protection factor, which it isn't currently. So we think that might be a mistake. That might be something that changes, but that's one we'll just keep an eye on and see what happens when it comes back after the consultation period. Finally then, unanswered questions. Yes, we have a few of those. First one we have here is, when this is a screenshot of the finance bill publication, the last page of it, of the 41 pages, there's a bit there that says transitional provision TBC, and that TBC is carrying quite a lot of weight. Yeah, we don't have a lot of information. I think the main thing on this one that we don't know exactly is, when you have a client that crystallises benefits, takes lump sums after 6th of April 2024, but has previously taken benefits, how they're going to treat those previous benefits. Which is why, obviously we have records of lifetime allowance usage, and that's why I say we still have to send out the statements this year of BCE events. But we don't, in all circumstances, particularly scheme pensions and things, if they tell you what the lifetime allowance is used, doesn't necessarily relate to lump sums that have been taken. So we don't know how that's going to translate into the new world. We also don't know whether it's going to make a difference whether you took your benefits, in 2022, or if you took them in 2002, and how that relates, in the new world to, has that used up, how has it used up your lump sum allowance, your lump sum death benefit allowance in the new world? They have not given any information on that yet, which obviously could be quite a big factor, and how these calculations and how things work. So we simply don't know. It is a watch this space. Other big one is taxation of beneficiaries' pensions. So I've talked about death benefits and paying out lump sum death benefits, because that's in the draft legislation we've seen. There is nothing at all in the draft legislation about beneficiaries' pensions. However, when it came out on the 18th of July, we had this policy paper that was published alongside the draft legislation. And it says, it's just this one line, there was no other information relating to this. It just says individuals will still be able to receive the benefits which are currently tested against the LTA at BCEs 5C and 5D, but the values will no longer be excluded from marginal rate income tax under ITIPA with effect from 6th of April 24. So BCEs 5C and 5D are when uncrystallised funds are used to provide beneficiaries drawdown, beneficiaries flexi excess drawdown under 5C and beneficiaries annuity. So currently, yes, these will be tested on death under 75 because these are benefits that haven't been tested under current rules, haven't been tested against the LTA in the member's lifetime. So at the moment, we have these tests against the LTA. Whereas that's going to go, because all the tests are going, around income, but it's saying, yeah, they're going to be subject to income tax. Whereas currently, if the member died under 75, obviously beneficiaries drawdown, whether it come from crystallised or uncrystallised funds, wouldn't be subject to income tax normally. So that's quite a big change, sort of policy change, which has not been announced anywhere. You might have seen some industry press that some stories covered this a little bit when this policy paper came out. But say there's nothing on it in the legislation, so we don't have any detail, but it is an interesting one. You know, logic would say to us, well, actually, you should only be subject to income tax if it's above the LSDBA, because that would bring it in line with what they're doing with lump sums. But on the other hand, you know, they're wanting this concept of only testing lump sums and not benefits, income payments, not pension income. So I don't know. So it's definitely a watch the space on this. Obviously, from planning, it would, you know, change things a little bit if you can take it out as a lump sum tax free up to the LSDBA. But if you take anything as drawdown, then it would be subject to income tax. So yeah, it's a watch this space. But yeah, could be some planning implications around that one when we find out what exactly is happening. And then summary, just to finish off then. So for this tax year, current tax year, we still have the lifetime allowance. We don't have any lifetime allowance charges. Big point is for people who've got enhanced or fixed protection, provided they had them by in the date of the budget, they can now make contributions. Next year, LTA is going, but it's going to be replaced by the LSA and the LSDBA. Protections will still be important for people, for your clients, because they will still help them have a higher level of PCLS. It's all still draft though, so things can change. And the big unknowns around the tax treatment of beneficiaries' pensions, how they work, and how previous BCEs under existing or old regimes impact the future lump sums that people can take. Right, that is all from me. So thank you very much for your time. I do hope that's been useful. Goodbye.
Thank you, Lisa, for that. If there's anything at all you'd like to ask Lisa on the session, do let us know and we'll come back to you with the answers. That concludes our webinar for today. Should you need to contact me or any of the speakers, please drop us the details in the comment section on the automated feedback form and we'll get in touch very shortly. Reminder that your CPD certificate and a copy of the slides will follow via email in the next few days. We have a few online sessions this week for various regions, so bear with us and we'll have your follow-up over to you soon. So all that is left to say is thank you very much for joining us. We hope to see you at the next one. Bye for now.